Well, good morning. It's Mike Sidhu here from IBCanada Group, and just with a bit of reflection and analysis on Bank of Canada Governor Tiff McClem's interest rate movement today, which was the overnight rate was bumped up by half a point, zero point 0.5 today. The minimum increment is about typically a 0.25%, a 1/4 of 1%. So this was a 1/2 of 1% move, which was in line with what most economists and pundits were suggesting that the Bank of Canada was going to do. The main reason why the Bank of Canada is eager to bump rates up is to sop up extra demand and remove demand in the market by making credit more expensive. So let's just kind of remind ourselves that what the Bank of Canada's mandate is, and that is to control the Canadian economy through centralized planning to have a steady state growth in the economy of 2%. But unfortunately, all the Bank of Canada can do is either purchase assets or sell off assets, and those assets become reserves to the commercial banks for them to lend. As Ludwig von Mises pointed out, the economy grows through central planning because of an expansion of money, both money and credit. Now, just to give you a little bit of background on this, the Bank of Canada, when they purchase assets, have to print, so to speak. There's no printer at the Bank of Canada. But what they do is they make an electronic entry in their computer, which increases the money supply, and that money supply is used to purchase bonds. And sometimes, as was the case through COVID, sometimes that's used to purchase equity securities in the open market, what they call open market operations. Now, because of the government demand for spending, the Bank of Canada printed 27% of the money that was ever printed since between about March 2020 and the beginning of 2022. And this is during a time where the economy only grew 2.7%. So when you have an increasing money supply with production that is also increasing, and if that is kind of the same production as money grows, then you don't have inflation and prices are steady. If you have increasing money supply again, but production is not growing, then you have moderate inflation. And in the case of the economic shutdown, when you have money supply increasing and production actually falling, well, when you have a greater amount of money chasing a limited amount of things, then the prices of those things tend to jump. Now, interestingly, when the Bank of Canada goes to now raise interest rates and raise the overnight rate, what they do is they sell off their assets, which effectively raises the interest rates. And unfortunately, they don't retract that money as easily as it's expanded, and I'll kind of explain why. When the Bank of Canada prints money, buys assets, the commercial banks lend against those assets up to 9 times the amount of reserves that they have. And commercial banks consider Bank of Canada assets reserves that they can lend against. However, as they lend more and more money, their own reserves, not just the reserves that they have with the Bank of Canada, but the reserves that they have within their own banking network, the network of commercial banks, they're able to lend off those 9 times. So there's a multiplication, and that's why Ludwig von Mises suggested that under central planning, the economy grows based on the expansion of money and credit. So when the Bank of Canada retracts their assets, that doesn't necessarily retract the assets and the lending that the commercial banks are doing. So we still have a lot of money and that's floating through the system. So the mandate, going back to the mandate of the Bank of Canada, when they raise or lower the overnight rate, they are essentially purchasing or selling assets that they have. And that's one of the only tools that they have. John Maynard Keynes said that it's government's responsibility to stimulate the economy. And what we're trying to avoid in that action is either high unemployment or recession, high interest rates, right? So they're trying to avoid it's like walking this razor's edge. And of course, no offense to Mr. McClem, but there's no way that he can know every buying decision of every Canadian. In a free market economy, the consumer is king. In a centralized planned economy, the government decisions are king. So what he's trying to do is centrally plan an economy, and therefore Canadians have to yield to his opinion on where he thinks, or where his committee thinks the economy should go. So again, in summary, that's the fallacy of central planning. Hayek wrote extensively about the fallacy of central planning, especially in his book, Road to Serfdom, which is a fantastic read from a Nobel Prize winner in economics, F.A. Hayek. And, that's the fallacy of knowledge as well, that any central committee person or planning department can ever know what your decisions are going to be. They try and make all these decisions, and you have to yield to their opinion about where the economy should go and where they think it should go. We shouldn't be afraid, in my view, we shouldn't be afraid of a recession if one should happen. And the reason for that is recessions are corrections in the price. That doesn't mean that there's, sure, it's painful, but it doesn't mean that it's a calamity to have a recession, or even a mild or short recession, which the free market can figure out on its own. There is no requirement for the Bank of Canada to centrally plan and try and figure out the economy for us. Well, we can do it for ourselves, but that's a whole nother topic, a whole nother story. Today's interest rate announcement is up by 0.5%. The dollar is up. The TSX is corrected a little bit down from the opening today as a result, because they were hoping for less of a raise. They were hoping for a 1/4 point raise. The market was, and that's why the TSX was up beginning of the morning and then down a little bit when the news came out that it was actually indeed a 1/2 point. And the final point about this whole thing is the market is addicted to government stimulus being low interest rate policies. Some people call this ZIRP, which is zero interest rate policies. And government stimulus, extra money, as we saw in March, April, May of 2020, the stock market went skyrocketing because of the stimulus that the government was doing. So in short, I don't believe that Tiff McClem, again, no offense to Mr. McClem, sure he's a great guy and he's a smart guy, but Bank of Canada governors have no idea what they're doing. They're just taking wild guesses, and if they're wrong, the people that pay the price are the consumer, you and me. We pay the price when they're wrong. We may benefit when they're right, but I think they've been marginally wrong over being right most of the time. So with that, I'll wish you have a great day, wish you well, and look forward to the next time we get a chance to talk. Cheers.